E 9.9. Steve Grant, the new controller of Green BR Limited, has reviewed the expected useful lives and residual values of selected depreciable assets at the beginning of 2020. His findings are as follows. All assets are depreciated by the straight line method. Green BR uses a calendar year in preparing annual financial statements. After discussion, management has agreed to accept Grant's proposed changes. A. Compute the revised annual depreciation on each asset in 2020. Okay, this exercise looks hard, but the logic is actually not that bad. So the first thing that you need to know is how many more years are we actually dealing with. Why is that? Because originally, for example, for building, we have two assets here. We have building and we have warehouse. Originally for building it was 40 years, but now we have 50 years. Can you just include 50 years? No, you cannot, because some of them have passed, right? Because this accumulated depreciation was at the year 2020, but originally we acquired in 2010. So the logic here is, first you're going to write how many years you had according to the old standards. 40, right? Okay, how many years have actually passed? You bought it on 2010, and this is the number that we got on 2020. So from 2010 to 2020, 10 years have passed. So we have to subtract 10 years. The new standards say that originally it was 40, but now there is 50. So there is an increase of 10 years. So we have to add 10 years. So how many years are we dealing with? We're actually still dealing with 40 years, okay? After the changes. Now we're going to do the same thing for the warehouse. Originally, it was 25 years, so we're gonna put 25. How many years have passed? We bought it on 15, and right now it is 20, so 5 years have passed, so we're going to subtract 5. And the new standard says that originally we have 25, now we have 20, so it decreases 5 years as well. So we are dealing with 15 years ahead of us, okay? All right, just keep these numbers for now. They're going to be useful in the future. All right, now, since we're going to be dealing with two different assets, I like to write them over here on the right, like this, and the other one here, just so it's easier for me to see. Okay, so the first thing that we need to know is the original cost of both of these assets. Building was 800,000 and warehouse was 100,000, and both of these are pounds. Okay, so you actually want to know how much is the current book value on 2020 for us to move on forward. How do you calculate the book value? Well, if you remember, when we use the table, we calculate the book value by having the ending balance. In our case, it is the cost, right? Because we don't have any depreciation that happened before, less the accumulated depreciation that has happened until that time. So over here, we are going to have less accumulated, write the full name, okay? Accumulated depreciation for both assets until now. For the building, it was 190, and warehouse, it was 18,000. So that is a minus, and here 18, which is also a minus. How much is that? For the building, we have 610,000, and for the warehouse, we have 82,000 pounds. And one more time, what is that? That is the book value at the year of 2020, which is what we need to know. Just one more thing before we move forward. Every time we calculate depreciation, remember there's always cost or beginning value minus what? Residual value over here divided by either useful life or how many miles or how many units that we could be used, right? So we're missing this part over here. We're missing the salvage value, and we also have to what? Less this salvage or residual value for both of them. For the building, the salvage value, okay, here's the catch. We have two numbers, right? Yeah, but the thing is that this number over here is until 2020. So for me, it doesn't matter how much was the residual value before 2020. I want to see the new one. I want to know how much will that be in the future. So we're only going to consider the proposed, the future value. For the building, that is 18,000, and for the warehouse, that is 3,700. Again, a minus. That is 592,000. The other one is 78,300. And what do these two numbers represent? They represent the depreciable cost. What does that mean? That means that after deducting all of the depreciation, the accumulated depreciation, the salvage value, that means that this is the amount that we actually can depreciate in the following years, the depreciable cost, okay? So let's just see how much would that be if we divide this by the number of years, right? Because remember that we are using, in theory, the straight line method, so it would be the cost minus the salvage value, but here we took down the depreciation first. So we did the cost, we did the salvage value part. Now we have to divide by the useful life in years, the new useful life in years. So we're gonna have divided by the number of remaining years, basically the new useful life that we calculated before. For the building, that is 40 years, and for the warehouse, that is 15 years. That gives us 14,800 for the building, depreciation expense for the year 2020, and for the warehouse, that is 5,220. B. What does it say? Prepare the entry or entries to record depreciation on the building on in 2020. Okay, I don't know what month that is, so I'm just gonna write the year 2020, and this is the basic entry for recording depreciation, right? So we're just gonna have depreciation expense at the top, and followed by accumulated depreciation, full name, don't forget, accumulated depreciation, followed by the asset. In this case, it is building. So we're only looking at the number for the building, and that is 14,800 for both of them.